This week on Wealth Track, index funds are more expensive, higher risk, and less diversified than you have been led to believe. So says global value manager David Winters. He presents his evidence next on Consuelo Mack Wealth Track.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Thornburg Investment Management, Active Management, Flexible Perspective, Rosalind P. Walter, and the Fairholme Foundation.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. I'm trying to get my head around the monumental flow of funds going into passive index funds and out of actively managed funds. Indexing is being presented as a no-brainer, a slam dunk. Even Warren Buffett, one of the greatest active investors of all time, has been recommending it for his family, friends, and just about everyone else. His now famous advice from his 2013 annual shareholder letter bears repeating. It is the instructions he has left in his will for his wife's bequest. My advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I suggest Vanguard's. I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers. In Buffett's view, practically anyone who doesn't buy and hold, invest in stocks as you would in a farm, as he once put it, is a high-fee manager. Well, it seems just about everyone is now following his advice. According to the Wall Street Journal, in 2016, 82% of new retail investments coming through financial advisors, more than $400 billion, went into index funds and ETFs. And it appears the lion's share has gone to Vanguard. Over the last 3 calendar years, Vanguard has received 8.5 times as much money as the rest of the mutual fund industry's 4,000 plus other firms. $823 billion for Vanguard versus $97 billion for its competitors. By one estimate, Vanguard traders put as much as $2 billion a day into stocks in their index funds, a huge portion of which goes into the 5 stocks with the largest market value or capitalization. 5 tech stocks, Apple, Alphabet, which is Google, Microsoft, Amazon.com, and Facebook, have dominated recently, and at one point accounted for 53% of the S&P 500's year-to-date gain. This kind of concentration is just one of the major reasons this week's guest is critical of index funds. He is an active manager, so they also threaten his business. He is David Winters, founder and portfolio manager of the global value-oriented Wintergreen Fund, which he launched in 2005. Wintergreen is known for its long-term investments in high-quality global companies. That focus delivered outstanding performance before the financial crisis, but has caused the fund to badly lag the S&P 500 since. However, it has outperformed a global index. Winters is an independent thinker who does meticulous research. He and his team have analyzed the financials of all of the S&P 500 companies and have discovered what they call look-through expenses, hidden costs which he says make index investing much more expensive than advertised. I asked him to explain.
Well, the idea of index funds originally was a good idea, Consuelo, and what's happened over time is that the fee looks low.
Right.
And that's what people concentrate on. But they don't look at the total costs. And the costs are that there's dilution from executive compensation plans that have, in 2015, are about 2.5%. And you can go through the filings and find it, but it's not easy to find. And that would be on average for the S&P 500. And then the other big expense is that stock buybacks, which most people believe are good for shareholders, have become increasingly used to offset these executive compensation plans. So another 1.6% of the expense of the S&P 500 that's not apparent is in these buyback costs. So we call it look-through expenses because you've got to look through.
Right.
And if you're a shareholder in an index fund, you own a piece of every company in the S&P 500 if you own.
So that adds up to 4.1% in these look-through expenses, these indirect expenses that you've identified at Wintergreen.
Right.
You did it because you were doing some work on Coke. You were a major shareholder of Coke
Right.
in Wintergreen Fund. How did you get into this? I mean, where you found all of these indirect expenses?
Well, there's a couple things that happened. Is we noticed that things were different in the market and the way that securities were trading and the relationship of value to stock prices. And so we started doing research. And then with Coca-Cola, there was a plan that would have effectively diluted the shareholders substantially. And
An executive compensation plan that you at Wintergreen fought successfully.
Yes.
Right.
And it was that plan that then gave us the idea that, well, maybe if it's at Coca-Cola, it's elsewhere.
Right.
And so we started this process, and we tried to find, a computer program that was out there. It didn't exist. So we had to go by hand through every company of the S&P 500, 10Ks, proxies, all their filings, the plans themselves, and we didn't know what we were going to find. And ultimately what we found was that there's 4.1% effectively dilution, look-through expenses, in the S&P 500.
Right.
So this whole idea that people have that index funds and ETFs are cheap, they're actually very expensive, and the expenses are ballooning over time.
And why are they ballooning?
Well, what happens is the executive compensation goes up.
Right.
And the buybacks have gone up to offset it. So it's not, it doesn't hurt the reported earnings quite as much. And, we're all for management getting paid,
right.
But we believe, this should be totally transparent. And it's created this distortion in the markets that people basically are all flocking to index funds, and they don't understand that they're expensive. And then we believe they're quite risky because the way the market weight works of index funds, what goes up has to be purchased in greater and greater size.
Right, and we've talked a lot about the market cap weighted indexes and how they get distorted. I mean, for instance, in 1999, if you own the S&P 500, you ended up owning, 30% of the S&P 500 was in tech stocks.
Right.
And so this is your point. The high risk is that there's a huge concentration, which you call them FANG and friends. Yeah. And so we've done the Facebook and the Amazon and the Netflix, but you're saying that with the friends, there are 10 stocks essentially that dominate the market cap of the index funds of the S&P 500, and that you're owning many more of those percentage-wise than you really want to.
Well, really what's happened is those securities, these fabulous growth stocks, which
right.
have changed the world,
yep.
All developed by brilliant people, have dominated the returns in the markets.
Right.
And so the index funds have to just keep buying more and more of them, so they become more and more of the index. So instead of this diversification, you end up with concentration. So you end up with high fees and concentration in, hyper-growth stocks, and the history of hyper-growth stocks, at some point they may not grow quite as fast.
There are alternatives now to market cap weighted indexes, for instance, which do eliminate the concentration that you get in those FANG stocks and their friends. What about those? Is that a better alternative? Is that a better mousetrap?
I think it probably is a better mousetrap. But the problem is, then there's this other issue about the opaqueness of the voting.
Right.
And the big index funds vote, in 2015, 95% of the time for whatever management wants. They're rubber stampers. And, oftentimes management is right, but what it does is it creates this spiral of expenses. And so if you have no one doing fundamental analysis, or very few people,
right.
and you have the index funds essentially endorsing these higher hidden fees, it's money coming out of investors' pockets. And over time, it becomes, even now, if you take 4.1% times the market cap of the S&P 500, it's over $800 billion a year.
Now, Jack Bogle, who created the index mutual fund, has been critical of institutional investors for a couple of decades now, because he's saying that they're not taking their corporate governance seriously, and that in fact that they do, rubber stamp most of what management wants. So that's really not different, right? You're just saying it's going to perpetuate itself. It's more dangerous now, or
Well,
what?
Jack Bogle's a brilliant guy, and he came
Right.
up with this idea, and and it dominates the market. And
Yeah.
it was one thing when it was just one segment, but now that it's whatever 30 or 35% or whatever the exact number is, it's created this enormous distortion.
Right.
And with the active managers, and historically active managers could choose to own, high dilution securities or not.
Right.
But now that everybody's getting pushed into the same securities, you have fewer and fewer investors who are basically standing up for their
I see.
investors, their shareholders, their fiduciary duty.
Right. Wintergreen has, expenses of 1.95%, and you and I have talked about this before. Morningstar says that's a high fee. So what's the justification? How do you compare what your 1.95% public,
Okay.
versus what you're paying that you don't know about in an index fund?
Well, part of this voyage of discovery that Wintergreen's been on with all this
Right.
is as we went through this, and we have an institutional class that's 1.7%, and then we looked to see, well, what were the hidden costs, the look-through expenses of our companies?
Right.
Because we own companies that generally have lower dilution, and our look-through expenses are the whole expense cost is 3.17% in 2015. An index fund
Right.
is 4.2%. So we're 25%. Our costs to the investor, not
Yeah.
only what you see, but what actually is costing you, is a big discount.
Right.
And we can own securities that trade at a fraction of what they're worth, as opposed to owning securities that everybody owns for the momentum. So we think that when you look at it, we believe the proper way,
Right.
Wintergreen's a bargain,
Yep.
and that the index funds are expensive, risky, and potentially at some point this bubble is going to pop.
One of your other major criticisms of index funds as well is that they've created this kind of momentum monster, you call it. Why are you calling index funds momentum monsters?
Well, because they've convinced everybody through all this extensive advertising that we don't believe is, entirely shows the true costs of this, that money flows in, massive money flows in every day, and it has to be put to weight in the market weight. And so what do they buy? They buy these 10 securities, and full disclosure, we own Alphabet for years.
Which is Google, right?
Which is Google. But, so these securities just keep going up and up and up. And every time in my experience as an investor that something becomes a momentum investment and people forget about the underlying fundamentals or they put it aside, and here fundamentals are less and less even considered, because part of the mantra of the index funds is don't think about fundamentals, just buy the index.
The fans of index funds
Sure.
also stress the fact that the performance of index funds has been better than most active managers. So 95% of active managers underperform their benchmark indexes over the last 15 years. What's the defense for active managers given that record, that track record?
Well, there's a couple of elements of this, is that everybody's looking at it today.
Right.
And since 2010, after the financial crisis and basically zero interest rates, this phenomenon of index funds became the dominant force on Wall Street.
Right.
And has become this magnet for capital all over the world. So people are looking, if you look at it, of course the active managers don't look as good. Because for the last 6.5, 7 years, that's what's worked. The second element is that active managers have been pushed away from really being active. And that if you look at this statistic called R squared, so many active managers are really index fund light.
Right.
And so you have...
So they're mimicking the index funds because they've got to in order to keep up with the performance
Right.
that they're under pressure to perform.
Right. So, and we're not trying to do that. So
Right.
at times we underperform, which is part of life. And this year, so far we're outperforming.
Right.
But, if you look at anybody who's really rich, They did it by owning a business or a series of businesses. They didn't do it by being average. And because of these fees, these expenses, these costs that are not well disclosed, we don't think that the returns of the index funds going forward are going to be nearly as good. The other element that people don't talk about is because everybody's in the 10 stocks, they're not looking at all these other stocks.
Right.
And they're not looking at fundamental values anymore. Some people are. But we can find securities, Consuelo, that trade at 35 cents on the dollar, and there's nothing wrong with them. And it's because people aren't focused. And also, no one's holding management to task.
And that's so I mean, how important a part of active management for you at Wintergreen is holding management to task?
Well, most companies we want to invest in, like BAT, they're great, you don't have to worry about them.
Right.
But then there's other companies that aren't doing exactly what's right. And we have shares of a company called CTO, and we're the largest shareholder, and we are in a proxy contest with them, and we're just trying to push them to do the right thing for all shareholders.
And why would you get involved with a company like CTO? And I'm not familiar with CTO. What is?
It's a land company in Florida with a 1031 portfolio.
Okay.
We invested in the company because we just thought it was ridiculously undervalued, and we invested, over 10 years ago, and just, we were concerned about certain things with them, and, there aren't that many people today who are willing to take a stance.
Right.
But we think the shares are very undervalued, and if, we are able to convince management to do the right things for all shareholders, everyone benefits.
Yeah.
So part of this is not only that the active managers have to be active, but that there is, we believe, so much to do today as a global value investor, because there aren't that many people looking, because they're all convinced through all these studies based on a backward-looking lens, not on a fundamental value lens, that there's a lot to do today.
And also overseas, for instance, of course, indexing has taken hold overseas, but is it to the extent that it has here with the S&P 500, for instance?
It's starting.
It's starting.
It's starting because, it's an opportunity for the marketers at the index funds, and it's happening. But that said, there's still a lot of companies overseas that are mispriced. We own a lot of companies that are basically kind of off the radar screen.
Right.
And one that's well known is Heineken, and the company's doing really well, and it's run for the shareholders, and it's got the family is super high quality, and they make a great product.
Right, and that was another. I remember another quality that you looked for. Who were the shareholders, and you liked owner operated companies. You wanted management that had skin in the game.
You really want the people who run these companies to have their own money side by side, that they've bought stock or they own stock, and they think and act like owners. I think where a lot of this disconnect, and the disconnect with the index funds, is you don't have this thinking like owners.
Yep.
And so we like companies that are run for the benefit of everyone in the long term.
There's another company that is actually not on anybody's radar screen that you're invested in Wintergreen. Tell us about Elbit.
Elbit Systems is an Israeli company that we came across because we were looking at the defense companies. And we kept looking, and I had a friend of mine who said, you got to look at drones a couple years ago. And he said, people do not want their children dying behind enemy lines. And so, this is a big change. You got to focus on it. And so I looked and I looked and I looked, and we came across an Israeli company, and we went to visit this company. And they are one of the biggest producers of drones in the world. They have, they're big in cybersecurity, which is now huge. The company basically is barely followed, certainly not in the States. In Israel, they follow it. And, it's well run. There's a family there. And we think it's cheap. And, in an uncertain world, Elbit makes a lot of products that help make people safer. And so, what we try to do at the Wintergreen Fund is figure out ways to participate in how the world is changing as well. And if we can do it in an undervalued way and in a way with good governance, and we think that Elbit Systems has those characteristics.
So I remember you were a big shareholder in Nestle at one point.
We own Nestle.
Major holding.
We like Nestle very much. It's consumer products have slowed down to a large extent, but it's a very high quality company that makes products that people love.
Right.
And they've moved up the healthy spectrum. And it's just it's a wonderful company. And, we own other companies, and we love Switzerland. We own a company called Sika, which is a specialty building products company that's got an interesting shareholder battle going on between the family and the company. And it's just a great business.
Yeah. Looking at, since with this move to indexing and this concentration in these, mostly tech stocks,
Right.
actually, where are you finding the most undervalued securities?
Well, I'll give you one
reflected?
that's just ridiculous.
Yeah.
And that we've owned forever. So we own a little company, it's not so little anymore, called Birchcliff in Canada. And it's a natural gas company. And we believe it trades at about 35 cents on the dollar. And the thing that's neat about it is the man who runs it, Mr. Tonkin, is, he has all his own money up. He's built the company. He's an honest, hardworking fellow. He's smart. And then the largest shareholder is a guy named Seymour Schulich, who's also a brilliant guy who's bootstrapped himself. And so, you're aligned with people who have all their own money up, who own something that's very undervalued, who've built it, and they get it. And so, we think there's a number of securities around the world that they're just so mispriced. And
It's so interesting because you talk to many other investors and they're saying the market's really expensive, it's very hard to find good value propositions, and you're saying not so, that there are a lot of them.
I think despite it's sort of the best of times, the worst of times, because of this whole index bubble, people now no longer believe in fundamental analysis and value investing and all this. It's just sort of, and there's all these studies out there. Yet, because of what's happened, there's all these neglected, unloved, and at some point, it's got to change. And so, we have all our own money up at Wintergreen. It's my money alongside, my business partner Liz Cohenauer's money, all my colleagues, the Graff brothers, and we believe.
Right.
And we have a great shareholder base, and there's room for more to join the party, because I think that what most people are doing is financially dangerous. And what we're doing, again, in my opinion, we don't take a lot of risk.
Yeah.
We own assets that are cheap. And in general, we have managements that wake up every morning and jump out of bed about how they're going to make money for everybody.
One investment for a long-term diversified portfolio. What would you have us own some of?
I always feel sort of intimidated when you ask me this question. But we really like BAT. It's our largest position. It's consistent with what the Wintergreen Fund owns.
Right.
They're doing this transaction to hopefully take complete control of the Reynolds American Tobacco Company. BAT is the most global tobacco company. It's very, very well run. Nicandro Durante, who's the CEO, is first rate. The team there is first rate. The company generates lots of cash. It generates money all over the world, so you have that sort of hedge. And you get paid to wait, and they grow the business.
Yeah. David, do you think that the indexing movement that we've seen, which is so enormous, how do you think it's going to end?
Consuelo, I don't know. I don't know. Some days I wake up and I think this is just going to go on forever. And that it's just, there's so much momentum, and they've convinced everybody that it's low fee and that it's just fabulous.
And you're well diversified and right.
But we also think one of these fabulous companies someday is going to have a problem.
Yeah.
It's always happened. And at some point the growth will stop, the music will stop, and I think that this is a bit of a game of musical chairs. And because everyone is so concentrated in effectively this one trade, and that is not what indexation was about when John Bogle created, his wonderful insight of the index fund, So, sometimes too much of a good thing isn't so good.
Perfect way to end it. David Winters, thanks so much for joining us.
Consuelo, it's great to see you.
Great to see you too. At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is be aware of the risks in the most popular index funds right now. As we mentioned earlier, just 5 tech stocks, Apple, Alphabet, Microsoft, Amazon.com, and Facebook, dominate the market capitalization weighted S&P 500 index and are responsible for the lion's share of its outstanding performance in recent years. That means the index fund portfolios are heavily concentrated and being run up by momentum as more and more money pours in. What runs up will eventually run down. Are you prepared to ride it out, or should you lighten up? Well, next week, successful stock picker Tom Gardner, CEO and co-founder of The Motley Fool, explains why index funds are the better choice for most investors, but for the hardy fools, he and his brother David have been building portfolios to last. To see this program again and hear more of David Winter's critique of index funds and defense of independent investment thinking, go to our website, wealthtrack.com, and keep reaching out to us on Facebook and Twitter. Thanks for watching. Have a great weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Thornburg Investment Management, Active Management, Flexible Perspective, Rosalind P. Walter, and the Fairholme Foundation.